It's great to have you join us on another edition of the only weekend business program on Channels Television. Capital Market is the end of the second trading week in September. Ladi Williams, good to have you join us. Let's begin the show with a quick review of the domestic stock market performance this week. We see the domestic equities market close positively this week as bargain hunting on Boa Foods at about 5.4%. Zenith Bank and Dangote Sugar supported market performance. As a result, the all-share index advanced by 0.91%, higher to about 68,143 points, pushing the month-to-date and the year-to-date gains to 2.4% and 33%, respectively. Similarly, activity levels were stronger as trading volume and value grew by 5.3% week-on-week to 38.5% week-on-week, respectively. Elsewhere, sectoral performance that was mixed as a banking counter at about 5.55%, consumer goods at a 2.34%, industrial goods that was down about 0.49%, and the oil and gas was down 0.12%. CWG topped the gainers list, up by 44.14%. Telegrams led the losers, down by 18.77%, while the trio of Wando, Fidelity Bank, UBA were the top three most traded equities for the week. And now we see the market here has witnessed an impressive three-month bullish rally since President Bola Tinubu assumed office on May 29th, 2023. So we can say the first 100 days have been quite good to the market right here. That's the local boss. Let's get more insight now from Mr. Rotimi Fakejo, equity trader with the Nigerian Exchange Limited. Great to have you on the show. Good evening.
Good evening. My pleasure.
Yeah, so if the all-share index is anything to go by at this point now, it's been quite impressive. Investors are quite bullish. We see President Tinubu's first 100 days in office, quite an impressive run we've seen now with the market. It seems investors should be thanking President Tinubu at this point.
Well, I think looking at the market critically with the performance that we have seen, I think we should look at three coordinates. The first one is a return on the investment by way of dividend, which has been outstanding and unwavering. The second also is the fundamentals of the various quoted companies. And the third one is the hope that people have in this present government and the future performance, which is inherent in the policies that we have seen so far. So investors believe strongly that with the way things are, I think the only investment destination in Nigeria today still remains the equity market.
And talking about new highs now, we're seeing the market, it's hit new highs we've not seen in many years now. And but we still have interest rates, high, inflation rate is high. Why do you think investors are still, so bullish regardless of the macro pains right now?
Well, I think if you look at how the market had been in years back and relative to the realities of the economy, vis-a-vis inflationary trend, vis-a-vis exchange rate, vis-a-vis various other variables, you will realize that the only thing that has not really changed before now is the prices of equities in the stock market. And is not far-fetched because some of my colleagues still say that the market as it is today is overpriced. For me, I think that is a fallacy because right now, if the price of, say, GT Bank was 35 Naira in the year 2008, when the Naira was just about 119, 120 Naira, and today, they expect that now today that the exchange rate is over 770 and the bank and the banks, not even to talk about what is obtainable in the black market. And the investors will the prices still remain as it were in 2008 when the exchange rate was at that level, and now that it's at this level, I think it's really not acceptable. Now, if you look at the figures that the companies have been churning out in the years past up to date. In those years, we used to see billions less than 30 billion as a profit after tax of majority of the banks. But today, we are seeing banks churning out over 200 billion. And so that is also another landmark that people have not really looked at critically. And if you also look at the quantum of dividend that was paid then and the quantum of dividend paid now, then you will agree with me that the prices that we are seeing right now are still very much in the low. And coupled with the fact that as things are right now, I think there is still a lot of upside for the equity market. And I believe strongly that people will begin to look at it in a different dimension. Before year 2010, our benchmark for pricing of securities used to be a dividend yield of about 10%. But I think all over the world, hardly will you see any place where the dividend yield is a benchmark of 10%. The high you can see in most places is a little lower than 5%. So I believe that the market is still rightly priced, even irrespective of what we are seeing in the larger economy. There are things good to happen in Nigeria if all, as we have agreed, that the pains of now will definitely become gains of the future if we are very steadfast in the way we are taking it. And I believe that, and I want to advise Nigerians that, yes, it's very extremely difficult for everyone right now, but I believe things can really get better than they are.
Right, definitely really painful reforms at this time. But, looking at the market now, how sustainable has the market been since, diminishing participation of foreign portfolio investors?
Well, I think we've had a lot of sustainability because when they pulled out, I think early in 2019, we believe that the market has come to his knees. Yes, he came to his knees at that time, but as they remained out of the market, maybe leaving just about 17% participation in the market presently, we thought that we are the only one that can actually build our market. All over the world, local participation in any market is always at the neighborhood of about 65–70%. And foreign portfolio investors take the remaining 30%. But in Nigeria, it used to be the reverse. But right now, I think we are actually consolidating. And I believe that strongly, if the only thing that can happen if foreign portfolio investors should come back is that we may see the all-share index tending towards 90,000 or even 100,000. Because there's still a lot of upside in the market and the value in the market is still very great.
And talking about hitting 100,000 with foreign participation, when do you see us crossing that 70,000 point level? That's looking like a newer high for the market if that actually happens. When do you see that coming?
Well, if it does not happen in the next few weeks, maybe a week or two from now, then definitely it will happen by the time we begin to see the figures for the third quarter of most of the equities. Because there are still outstanding. We saw the result of GT Bank coming into the market. It gave the market another lead. We are expecting the results of Zenith Bank, Access Bank, and even UBA. I believe that definitely we're going to see another dimension of upward movement for the stock. So we may definitely see 70,000 basis points in the next few days or even about 2 weeks.
And definitely, we're expecting inflation figures. That's next week. That's for August. Do you see that, pushing investor sentiment in any way?
Well, I think for most times, the inflation figures are always priced in before they are actually released because we are already feeling the impact. So it's only for official purpose that those figures do come out, and by the time they do, the effect is already priced in, and so the publication of such figures do not really matter as much as we have seen over the years. So I believe that with those figures coming, even as it might inch up a little more, I believe that the market definitely will remain resilient and will not see any way southward.
Yeah, I guess investors have shrugged off a lot of big macro issues at this point. But a month after the UK Consumer Health healthcare giant, that's GlaxoSmithKline, announced the exit of its Nigerian subsidiary from the stock market. Another domestically listed British personal healthcare product and consumer goods company that's talking about PZ Cussons. They've concluded plans to delist from the NGX. How are you seeing this?
Well, I'm seeing this is a very sad occurrence because the days that Nigerian bottling company, the duo of Nigerian bottling company and 7-Up left the market, it was really, really a very sad event for me and also for the market. Now that we are seeing more quality listed equities leaving the market, I think we as operators, along with the regulators, need to sit down and ask what actually are the problems. Why would they prefer to become unlisted rather than listed? So I think we need to take a holistic approach at this and actually find a lasting solution to what is actually costing them. The reasons behind them leaving the market. But for me, I think the regulators have to be up in their games. There needs to be an approach whereby, not that the market has free entry and free exit, but at the same time, if the right incentives are there and there are no deterrents, then definitely we may see them continually going, remaining listed. And I think we do not have enough quality listings on the exchange right now. So it's a very, very bad omen for us to be having more and more quality listings leaving the market.
And how would you say a bull market or a bear market impacts, companies, when it comes to delisting or listing? Seeing a company wanting to delist during a bull market, what does that really tell us?
Well, I think it's not really about the market being bearish or bullish at any point in time. I think it has to do with fundamental issues, which I believe they will have been communicating to the exchange over time, and which they believe that maybe enough has not been done concerning such. So I believe strongly that we need to look at the fundamental issues. Definitely, these quoted companies won't be doing this because they want to do it. There are reasons for it. And I think for me, there needs to be a stopgap or a bottleneck, positive bottleneck, put in place that can actually make them to look back and say, okay, let's continue and let's see whether there be differences in time to come. So I believe that this shouldn't be again. It will be very devastating if we are going to see another company showing up and say they want to delist. It's going to be very devastating for the market.
And talking about another company wanting to delist, what impact is, what we're seeing with PZ Cussons? How's that impacting their peers, which are listed on the NGX, say in the medium to long term?
Well, I think when Nigerian Bottling Company came and applied to be delisted, we took it with kids' claw and said, okay, it doesn't matter. But shortly after that, we saw 7-Up coming up, and eventually they got delisted. So if we are already seeing what is happening right now, PZ Cussons is already saying this. We know fully well that Unilever is also in the same bracket with them. It will be very devastating if you're going to have a repeat of such coming from the likes of Unilever or Nestle in the nearest future. So I believe that we need to take a holistic approach at this and see it as a critical concern for everybody to know what to do and make the right approaches.
All right, I guess we want the listings for the right reasons and listings also for the right reasons. Thank you so much, Mr. Rotimi Fake-Ejo, equity trader, NGX Limited. We hope for more listings on the exchange.
Thank you.
Watching Capital Market live on Channels Television. Well, Nigeria's fixed income market has been fluctuating for some time now as both the Treasury bills and bond space close the week bearish. To shed more light on the markets, let's talk to Mr. Bankole Odusonya now, Chief Dealer, Polaris Bank. Great to have you on the show. Hello, Mr. Bankole.
Hi, good evening. How are you
Good evening.
doing?
Fantastic. Yeah, I can hear you now. I'm doing great. So we're still in the week marking the 100 days in office for President Bola Tinubu, who announced back in June a number of reforms across several sectors of the economy, particularly the financial market. How have the reforms impacted the fixed income space in the last 3 months?
Thank you very much. The initial step they took was to liberalize the FX space and ensure all FX trading activities return to the I&E market. The I&E market wasn't a new market, but there were other platforms where FX was applicable at different rates. So right now we have just the I&E market with a single rate. As we speak, the rates are ranging between 770 and 780. So it's one official market rather than having multiple rate system that we had before. So right now the official rate at the I&E market is actually single and even closer to the alternative market. Beyond that, petrol subsidies were removed, and we've seen that there's been spike in activity from oil marketers. As a bank, we know that issuance of credit to oil marketers has also increased. So it's not just NNPC bringing in fuel into the country. We know that oil marketers are bringing, a few licensed ones are bringing in fuel, and then risk assets are going up on the back of this, impacting the liquidity of banks. Of course, central bank had also made adjustment to ensure that LDR assessment was resumed. 65% of your total deposits should be, a minimum of that should be deployed to risk assets. So what has happened is that the central bank is back to check it. And for banks who default and have not issued enough loans to the real sector, a percentage, 50% of the gap will then be taken by the central bank away from those banks. So in all of this, the central bank under this new administration within 100 days is trying to stimulate activity, ensure lending to the real sector, and at the same time ensure that we have a single rate system at the I&E market.
And looking at what's happening in that space at this point, with what the central bank is trying to do now with the banks, how do you see this impacting inflation going forward?
Yeah, the inflation challenge remains. I'm going to be honest with you. But what they are doing is, it seems as if they are taking it a step at a time, liberalize the FX market, and then move closer to ensuring that interest rates are modest, because they've spoken to that effect so many times. And then we have another monetary policy meeting coming up next month. We've seen what happened, the marginal increase at the last MPC meeting. Going into the next one, we do not expect a major hike also, because they are very cautious of rates at which banks are lending to the end users. That's the real sector. The central bank in this administration and then the Ministry of Finance has made it clear we want to improve lending, and then to ensure that the cost of lending is also manageable. The source of our Nigeria's inflation is mostly cost-driven, given our infrastructure gap, and then being import dependent. We're importing a lot of inflation because inflation is a global phenomenon, and because we are bringing in a lot of services and goods, we're importing a lot of inflation. So it's cost driven. The central bank is trying to use its monetary policy tools to manage this. We have seen the central bank on the 10th of August issue OMO bills at 14. This is not just to take out system liquidity, but also attract FPI. So it's like using one stone to kill two birds. We have seen that they've also given pronouncements on several issues concerning beyond FX, even on the asymmetric corridor and the overnight market, ensuring that rates are not very high when there's liquidity in the system. As we speak, we closed last week with rates between 1% on the interbank, that's the rate at which banks are lending money to each other, between 1 and 5%. Whenever a system becomes illiquid, it spikes to as high as 25, but usually it doesn't take for more than a week or two before federal allocations come in to douse that pressure. So basically, that's where we are with interest rates and managing of inflation.
Right. I guess the inflation battle continues at this point. But what is the level of investor sentiment across the fixed income market?
We are seeing more action on the short end of the market because of yield expectation. If you look at the bond auction results between August and July, we've seen a 100 to 150 basis point spike in yield. And if you relate that to pricing, prices have crashed, and then there's revaluation loss on long-term bonds. And most participants, asset managers, brokers, and even PFAs will be feeling the pinch by now. So what's happening is that we're seeing a lot more activities on the Treasury bills end, where rates dropped from 13.9 at the last NTB to 12.5. We expect this to continue to moderate because interest is shifting back to the short end of the market, where term deposits, Treasury bills, and maybe the short end of the promissory notes are more attractive to investors. You don't want to be holding assets at 14%, and then in 30 days time, those assets shift to 15 and the possibility of going to 16. So right now we're seeing apathy at the medium and the long-term end of the fixed income securities yield curve. We're seeing more activities at the short end. On Monday, there's a bond auction. It's a space to watch. We have seen rates go from 15, 15.5 and 15.8 for the various bonds on auction, 2033, 2029, 2038, and 2053. We expect that yields will marginally go up again to 15, 15.3, and 15.95, almost touching 16. And so because of this expectation, we have seen more activity on the short end, people managing their duration risk and trying to key in later when yields are perceived to be at the highest. That's the plan.
Right, investors want a good buck for the money at this time. But what is your outlook for the market, fixed income market, within the month of September?
In the month of September, there's going to be a monetary policy committee meeting. After that will be exactly a week after inflation figure comes out by September 15th. All that will happen next week. So just like I've explained, it's a space to watch. I'm not seeing aggression on the medium to long end of the bonds market. We're seeing more of short-term trading, holding short-term assets, and you see T-bills swap rates continue marginally reducing, whilst bond will marginally go up. So it's a positive curve. It's what it's expected given our level of inflation and interest rate direction, where we expect inflation to keep up the pressure, and then the central bank keep up its fight against inflation. So basically, interest rates has a room for improvement. Inflation could even marginally continue to inch up, and then we're seeing more actions on the Treasury bills end.
Right, I'm talking about inflation marginally edging up. What are you expecting next week for the August inflation data?
It's currently at 24. It could hit 24.5 or even 25. It's a possibility given the adjustment we had seen from the National Bureau of Statistics. But we expect that all things being equal, it's going to continue to inch up. I mean, with the major impact coming in from petrol prices. And then with more money coming into the system later, with minimum wages adjustments and all that, we expect more money to chase few goods because we're not even producing so much. We're importing a lot. And then if you follow the news globally, you see that prices have gone up, even of the imported items. And then because of the pressure on the Naira, the rate at which we are sourcing for FX. So all this dovetails into the pricing. So just FX pricing, the petrol prices for logistics, all of these dovetails into, and it points at one thing, marginal or continuous increase in inflation for now. The central bank is not relenting. We know that at every MPC, they will try to, use the monetary policy tools to manage the situation. But I mean, going into next year, we'll be seeing year-on-year modest adjustment, because by then there will be base year effect next year, because the prices are high this year. If you're comparing next year's prices to this one, the movements may not be as volatile as we are seeing. But going into the last quarter, we expect inflation to continue to inch up, and we expect central bank to continue to marginally increase MPR at the MPC.
Right, I guess 2023 is all about price at this point. Thank you so much, Mr. Bankole Odusonya, Chief Dealer, Polaris Bank. Thank you so much.
Thank you.
All right, let's take a look at what's to expect next week. See, the DMO 360 billion naira bond auction offer, that's Monday, September 11th. Markets eye September inflation report. All eyes on that inflation report. See what's going to happen next with the rate. Bonds market, we see bond auction results to influence the sentiments, expected to influence sentiments in the secondary market. For the T-bills market, the second primary auction on the week of Wednesday, September 13th, we see the CBN roll out overnight about 152 billion naira worth of maturities. For the money market, 360 billion September FGM bond auction debits to offset expected 51.12 billion inflows from coupon payments and about 10 billion naira over maturities for the equities market. We're expecting mixed sentiment. That's anticipated amid current rally in the market. Also looking for maybe new highs. All right, so that's the show today. Thank you so much for watching. I'm Vladi Williams. See you next weekend.